Hello, my name is Thomas Key, and I am President and CEO of Stock Traders Daily. Today, we're going to talk about something extremely important. We're going to talk about where the market's at, where it's likely to go, and what it is that we should be doing about it. We're going to talk about valuations to start, specifically valuations for the Dow Jones Industrial Average. We'll incorporate earnings growth and price earnings multiples into this evaluation. Then we're going to go into the investment rate, and that means the macroeconomics of today. I'm going to talk about stimulus, market levels, the risks that exist, and then we're going to conclude with an answer to that all-important question. Given what we know, what should we do about it? Regarding valuation, we're going to start by looking at the price-earnings multiple of the Dow Jones Industrial Average. Currently, the PE ratio is just over 15 at 15.38. 1 year ago, the price-earnings multiple was 14.38. Over the course of the last year, there has been multiple expansion in the Dow Jones Industrial Average. Typically, that is associated with higher levels of growth. We will compare earnings growth accordingly to see if that's justified. This is the earnings analysis page offered by Stock Traders Daily. It can be found in the Stock Market tab and the earnings link within that menu. This is a fourth quarter view. We're going to take it for the Dow Jones Industrial Average. This is for the fourth quarter of 2012, and what it shows us is that the earnings per share growth rate for the Dow Jones Industrial Average is actually negative 0.58%. Revenue growth comes in at 0.18%. This is for the fourth quarter, so let's take a look at the third quarter so we have some good comparative results. In the third quarter, the EPS growth rate was a little better at 3.49%. However, in the third quarter, revenue actually contracted for companies in the Dow Jones Industrial Average to the tune of negative 2.1%. This has been a trend in the Dow Jones Industrial Average and the S&P 500 for quite some time. The S&P 500 has looked a little better than the Dow, but the multiples on the Dow Jones Industrial Average, currently over 15 times earnings, are not reflecting this low growth rate that might also be construed as contraction. In fact, the multiple expansion that's gone on over the past year is not warranted at all. Let's look at this page again. Does the Dow Jones Industrial Average deserve the multiple expansion that's gone on over the past year? Also, does the Dow Jones Industrial Average deserve to be trading over 15 times earnings given its meager growth rate? My answer to both of those is no. I think instead multiple contractions are looming, and the Dow Jones Industrial Average deserves to be at a much lower price-earnings multiple given what looks like a very slow economy in the year ahead as well. Keep in mind, GDP levels are expected to contract in 2013, and the already weak growth rate of the Dow Jones Industrial Average can get worse. Although it might not actually get substantially worse, even if it doesn't improve, the current multiples are not warranted. with added pressure from GDP contractions, the revenue and earnings growth rate of the Dow Jones Industrial Average is not expected to improve materially. This brings us to a discussion of the investment rate. The investment rate can be found on Stock Traders Daily in the Economy tab under Investment Rate. The longer-term chart of the investment rate starts in 1900 and extends out to 2030 and beyond. It shows us that there have been 3 major down periods now in U.S. history. The first was the Great Depression, the second was stagflation, and the third began in 2007. It is the current economic environment that we are in today, and it lasts until 2023. We all know what happened during the Great Depression. We all know what happened during stagflation, and we are living with those same exact risks today. In addition, and maybe more pronounced, is this more focused view of that investment rate chart. Yes, the decline started in 2007. Yes, they last for quite a while. But the rate of change of those declines increases substantially at the end of 2012. This means that the rate of change in the amount of new money slated for investment into the U.S. economy on a naturalized basis declines substantially in the years immediately ahead. That means that risks can increase measurably, and when increased risk hit this stock market, the stock market can fall aggressively. That is especially true when the natural rate of demand falls aggressively as well. The investment rate tells us there are substantial risks. We are nowhere close to being out of the woods. But what about stimulus? The decline in the natural rate of new investment dollars, that's eye-opening and that's meaningful. But if they keep printing money, might it offset this natural weakness? It has thus far. The economy and the stock market would look much weaker if they weren't printing money. So let's take a closer look at stimulus. I've actually already done that in a special report. It's an effectiveness assessment of QE3. I'm going to let you read that yourself. But I'm going to tell you what it says. We talk about the real stimulus from QE2. We talk about the real stimulus of QE3. And I reach a couple conclusions. The conclusion is that with refunding, the actual stimulus of these QE programs is far less than what they appear to be on the surface. QE2 was largely stimulative. There was about $30 billion of new liquidity infused into the system every month. The face value was $100 billion, but the Treasury was also issuing more bonds. So the real number was about $30 billion. This QE3 program, this endless stimulus program, on the surface, is also stimulative. to the tune of about $11.5 billion every month. The interesting thing, though, is now something else is happening. Monetary policy is one thing, but now there's another part of this equation, and that comes in the form of fiscal policy. In fact, given what's happening now, fiscal policy is tightening, where monetary policy is still loose. And my estimates suggest that what we have already will cause a drain on liquidity on a monthly basis of about $16.6 billion, therefore offsetting the $11 billion of stimulus that would otherwise be there if QE3 were standalone. But it's not. Fiscal policy is there too. I'm going to let you read this. It's detailed, it's effective. It's probably not an easy read for most people, but the conclusion is that our government, with both monetary and fiscal policies included, is now a net drain on liquidity. This was not like this last year. This was not like this the year before. In fact, this is the first time since this credit crisis that our government is a drain on the liquidity in our system. Therefore, if you believe that this endless stimulus will get us out of this mess, you need to recognize that the stimulus of today is not what it used to be. In fact, I would argue that as these declines in the investment rate get worse, they are going to have a much more material impact on our economy because the stimulus that we have been living off of for so long is no longer there. In fact, although we don't know what's going to happen with the added budget cuts scheduled for a month or two from now, those will add more pressure to our economy. Those will drain liquidity levels even more. But where we stand today, there is already a net drain on liquidity from our government, given both monetary and fiscal policy, to the tune of about $5.2 billion per month. That was not there before. This is a big deal, and it will add pressure. Given what the investment rate says, this is a very, very bad time to add pressure to this economy. Now, let's turn our attention away from valuation and the macroeconomic picture, and let's look at the market. This is the S&P 500. Starting in 2000, going through our current market levels, the S&P 500 is back at highs from where it has fallen aggressively before. In 2000, the S&P 500 was just over 1,500, and it turned down by more than 40%. Staged a comeback, then peaked in 2007, and once again fell aggressively from just over that 1,500 level. Now, once more, the market is back over 1500 again. The question is, will it turn down like it has before? No one really knows. No one can be sure. But what we do know is that it has happened before. In fact, it has happened twice. Therefore, we know it can happen again. And for the intelligent investor out there, that is almost all that matters. So what do we do about that? Yeah, the S&P is basically flat. It's gone nowhere since 2000. That's 13 years of doing nothing. And now the risks are there again. It can fall, just like it has twice before. So here's my recommendation. Keep it simple. Use a strategy that has been able to make money even from those relative peaks. I'm picking one out here specifically because we started this strategy in December of 2007 when the S&P 500 was at its last peak. Since then, the Stock of the Week strategy is up over 200%, and the S&P 500 is flat. This is a big deal. And it tells us that there is an alternative. There is a choice. Proactive trading strategies can work, but they also require a little bit of work. When the market goes straight up, no one cares about this sort of stuff. It is only when the market gets hammered that people start to really care. But as I'm demonstrating right here, proactive trading strategies can far outperform the market. But don't misunderstand what I'm saying. Proactive trading strategies are far from perfect. In fact, the market itself, as you know, is far from perfect. However, when you are engaged in strategies that are capable of making money no matter what happens to the market, the risks that we have demonstrated and proven about the economy no longer matter. The risks that the investment rate warns us about, the risks that exist given what's happening on the fiscal policy side, the drain that's happening in our economy now, the pressure that's going to be on GDP, all of those concerns stop mattering when we engage in proactive trading strategies that are capable of making money even from market peaks. The one I am sharing with you here has increased over 200% since December of 2007. It is extremely easy to use, and my recommendation to everyone is to strongly consider either following this strategy or learning how to develop it for yourself. It is a very easy strategy. It can be found on Stock Traders Daily under Stock of the Week. Regardless of what you decide to do, you just need to recognize that the risks are extremely high. The market has fallen from these levels aggressively before, and it can do it again. We also know that the investment rate tells us that the declines get much worse. We know that liquidity is not what it used to be. The printing of dollars is not going to help when it's offset by fiscal tightening. So the infusions that we've been accustomed to in years past are no longer there either. Things are different. They can get much worse. The economy can start to deteriorate, and if it does, it's all going to be natural, because the investment rate proves that we are in the third major down period in U.S. history. This is all about people, and nobody can stop it from coming.